Housing prices are on the rise, Citigroup got the axe out, and we've got big news from the Canadian Warren Buffett. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. I am Matt Copenheffer, and right here next to me is David Hansen in a great-looking shirt, David.
I would say the same to you. It looks very
fantastic.
nice.
Hey, David, so you are a University of Miami graduate. After a 77-7 drubbing of Savannah State, Miami is now 3-0, ranked number 15. What's the season look like?
Going forward, this week we've got South Florida. I think they're 0-3, so the good news should continue. Our quarterback got a little dinged up.
So Miami did a good job creating its schedule, it sounds like. Exactly. Savannah State, South Florida.
Well, we beat Florida.
Well,
there we go.
All right. Well, we've got a great show today, and starting out, we've got what I was referring to in the intro, the Canadian Warren Buffett, Prem Watsa at Fairfax Financial, offering to buy out BlackBerry. This is the headline from the Wall Street Journal. BlackBerry strikes preliminary go-private deal for $4.7 billion. Is this a Warren Buffett type deal that Prem Watsa is making?
It doesn't seem like a traditional Warren Buffett type deal, but I think a lot of people are going to look at this and say, this guy doesn't know what he's doing. Why would you buy BlackBerry? That's a business in decline. But Prem Watsa's got a pretty good track record to speak for itself. So I'm going to step back and say I'm going to give him the benefit of the doubt that he knows what he's doing here.
So why would we call him the Canadian Warren Buffett? Well, for one, Fairfax Financial is a collection of insurance businesses that happens to have a very good investor working with the company. Again, that's Prem Watsa. Between 1986 and 2012, the total return on the investments at Fairfax Financial were 9.4%. That's against 7.6% for the S&P 500 over the same period. So I think it's pretty fair to say that Watts has done a pretty good job. And remember, that total return, that's going to include bond portfolios as well, because they're insurers. The other major investments that Fairfax has right now, so in case you're looking at what else is Prem Watsa looking at right now? Level 3 Communications, got a big position there, a very large position in Johnson & Johnson. Resolute Forest Products is another big position, and SandRidge Energy kind of on the border there in terms of a big position. And of course, BlackBerry was and could be is the key here. This is sort of like a backstop offer, which makes me a little bit uneasy about what they're trying to achieve here, because everybody sort of knows that this is a backstop offer. Maybe Fairfax will end up buying it out, but I can't imagine that there are other buyers out there looking at this deal and saying, well, they're getting scared, so they put together this deal. Yeah, I'm definitely going to step in there and try to buy out these assets for more than that. I'll be interested to see what happens, but I'm skeptical. I'll admit I'm skeptical. I think Prem Watsa is a great investor, but I'm skeptical of this deal.
We'll see. All right, next headline is from Bloomberg. Fiat threatens Chrysler pullback with union-pushed IPO. So we got the whole Fiat Chrysler deal, wanting to buy out the company, then saying, well, maybe we'll go through an IPO process to maybe, I guess, threaten. Can we say threaten to maybe take that offer price?
Yeah.
The one thing we talk about financials in here was JPMorgan is running the IPO process. So if it goes through, JPMorgan would probably be one of the lead book runners, if not the lead underwriter. If it doesn't go through, they still get their fee for managing the IPO process. So whether it's a win-win for Chrysler and Fiat, it remains to be seen, but it's definitely a win-win for JPMorgan.
It seems like a win for JPMorgan, and maybe it's not too surprising to see them there. When General Motors went public through their process to sell out the government stake, it was Morgan Stanley, JPMorgan, and Goldman Sachs managing that IPO. And we should probably also mention that Lazard is in on this action too. One of the smaller boutique investment banks, they're advising Fiat, helping them decide what their best move is. So I'm sure they had a hand in figuring out this IPO thing.
Right.
Third and final headline here from CNBC: futures edge higher after CaseShiller housing report. The 20-city CaseShiller index was up 12.4% year over year. Phoenix has now had 22 consecutive months of positive housing price gains. Las Vegas up 27.5% in July. The housing market seems to be on fire.
I guess so. It's worth noting that these are for July. And I mentioned yesterday on the show, we saw mortgage rates really move up after July. That's really where they settled in at around 4.5%, where they still are now. So it'll be interesting to see next month if the growth starts to slow a little bit. And you mentioned some of the markets there. Another one is Atlanta. That's up over 18% year over year. And if we think about the banks in that area, we look at SunTrust. They have around a third of their loan portfolio tied to residential mortgages there. So rising home prices in the Atlanta area, in the Georgia area, that's good news for them. Less so for a bank like Synovus. They do have exposure into Georgia, not as much as SunTrust. But regardless, as we continue to see consumers get equity back in their house, that's good news for these banks.
Sure. And I should note that the one bit of cold water to throw on it, I don't even think it's that much of a cold water, is that the gains, the pace of the gains are decelerating a little bit. So maybe next year we're not going to see San Francisco, another market. This one really shocked me because it's San Francisco, up 25% year over year. Don't think we'll see that kind of gain between this year and next year. Moving ahead, we've got a few more headlines. Hit them a little bit more quickly in rapid fire style. Go for it.
First headline I was looking at was from Bloomberg. JPMorgan Chase, 12 more banks said to be sued over LIBOR. I saw this headline. I said, what year is it? Is it 2012 again?
2012 call.
I thought we already settled this. And okay, the only bank they mentioned there was JPMorgan Chase. The other ones were just 12 more banks. I think it's really just a headline. They're trying to say, look, more trouble for JPMorgan. Again, it's not a huge deal. If there's a small fine, they'll pay it and move on.
Imagine that, JPMorgan. So we've got a headline from Bloomberg. Citigroup to cut 1,000 in mortgage business. This follows on, we saw Citi cut 120 people over the summer. This is just an add-on to that. From the article, it said separately, Citigroup is hiring employees to originate new mortgages for home purchases as opposed to refinancings. So I guess they're rejiggering their lending portfolio, their mortgage business, which is basically what everybody else has been doing. Bank of America, JPMorgan, Wells Fargo, all making headlines because they're cutting people in their mortgage business as well.
Speaking of mortgages and homes, another headline from Wall Street Journal, Lennar earnings surge in deliveries, orders boost profits. They reported earnings, strong profit growth. Same thing over at KB Home. I think profit was up like 300%, but that has more to do with last year rather than really growing earnings at 300%. So again, the home builders doing well, but from a stock perspective, they're not dirt cheap, in my opinion. There's this theory that, okay, there's a shortage in supply. The home builders are going to be great investments over the long haul. Well, that theory is pretty well known, so I think you have to be a little bit picky in terms of when you look at these stocks, who's really going to win over the next 5 years.
But those mortgage rates don't seem to be eating into that profit quite yet. Wall Street Journal, again, we got JPMorgan here, imagine. JPMorgan ex-traders are citing whale in their defense. This, I just had to put this one in here. I thought this was really funny. The government's approach, I think, was basically to get Bruno Ixel in there. They have a deal with him to not prosecute him. He was the guy that's actually known as the London whale, this Bruno Ixel. And so they're now trying to prosecute 2 other people involved in the situation. And the hope was that everybody would start pointing towards the higher-ups at JPMorgan. And that's not exactly happening. Everybody's pointing, this whole little group here, they're all pointing fingers at each other.
Right. Last headline of the day from the Wall Street Journal. Some smaller banks still owe TARP money. And the number in the article was 113 small banks still owe. Many have missed dividend payments to the government. Some banks have gone bankrupt under not being able to pay and just the business folding up there.
But big banks are they're the troublesome ones.
Yeah, again, this highlights that it wasn't just the big banks. The big banks have, you could argue maybe they've had a little bit more opportunity to get their business on the right track. But we got to remember it was these smaller banks that didn't fare so well during the recession. Small banks aren't guaranteed to be great investments. You have to be picky. You can't just say, well, it's small, it's easy to manage, this is a great stock. You got to be diligent in terms of what you're looking at. Is the bank still performing well?
All right, moving on to, we're going to dig into one of the important concepts in the banking business today, and that concept is net interest margin. This is one of the core things that you're always, any investor in the banking sector, when banks come out and they announce earnings, we're always going to be looking at this number. And unfortunately, This is not like golf. A lower net interest margin is not better. And what we've seen quarter after quarter of late is net interest margins at all of the banks, pretty much all of the banks, falling. There have been some quarterly respites for some of the banks, but because of the low interest rate environment, this has been a downdraft. But on a very basic level, what is net interest margin?
What is net interest margin? It's a very exciting subject. So to show you, we'll throw up a graphic here on the screen just in terms of what's very basic. How do you even get to that number of net interest margin? So on the top left there,
I love that background, by the way.
Oh,
that reminds me of like a 1970s
Thank you.
business card.
It's a very nice color. So on the top left, you have all these assets that are bringing in interest to the bank. So business loans, mortgage loans, credit card loans, corporate bonds that they hold on their balance sheet, securities, mortgage-backed securities. So all that interest is flowing into the bank. And on the right side, the bank is paying interest expense on our deposits, on our savings, on our CDs, on any debt that they have. So you take the interest coming in, minus the interest going out, and that's your net interest income. All of that over all of the assets that the bank has that are earning interest at the time, and you get your margin there. So if you just step back and look at the pieces, that's really how the business is flowing. And it's really not that complex of a topic. It can get a little complex in terms of what's driving the income, but from just a high level, it's interest coming in. You got to remember that you're paying out interest on those assets, and then that's the margin there.
Sure. And when we look at banks from a very high level perspective, particularly with the big banks today, we think about a bank like a Bank of America, or even U.S. Bancorp. Bank of America, the larger ones, JPMorgan, Citigroup, with the large trading operations, we might expect to see a lot of fee income from there. But even as we step down to the somewhat smaller banks, to like a U.S. Bancorp, and I don't know the number off the top of my head, but I'm guessing M&T, BB&T, that their revenue tends to be split somewhere in the 50-50 kind of range between interest income and non-interest income. And so when we talk about net interest margin, we're talking primarily about the interest income side of that equation. So you take all of those assets, just like you were talking about, and you look at the spread that they're earning on them, and that's what's going to drive the revenue, drive the profit that they're actually earning on the lending operations. So one of the things that I think that we should touch on here is that I think it would be easy to look at the net interest margins across banks and think, well, a higher one is obviously better. So a bank with a higher net interest margin is a better bank. But it's not quite as clear as that, right?
Right. So we step back and just look at the industry as a whole. So let's look at the past 20 years. And we have another graph. You mentioned in the intro that these margins have been falling. And there you go. There's the last 20 years or so of what net interest margins for all U.S. banks have been doing. And you can just look at since 2010, when the Fed really dropped interest rates long-term and short-term, that margin has been compressing there. And then when we go to individual banks, we got another graphic. I know you love these graphics.
I love it.
So there you go.
At least these don't have that weird back.
That's a good, the white is good as well.
The white is good.
So like you said, you can't just take this number and compare across the board and say, okay, this one's higher, so it's better.
So if I was doing that, I'd look at this and say clearly Capital One is the best bank, and I guess BB&T second best bank. How is that not true?
So obviously Capital One, a little bit of an outlier there, double what even some of the next closest competitors are, and you'd say, wow, is Capital One just that good? Well, no, you have to look at those assets, that top left-hand corner of the first graphic. What are the assets they have on their books? We look at Capital One, obviously, big credit card operations. Around 30% of their portfolio is credit card loans. And if we think about credit card loans, those are usually yielding double digits at some levels. So you have to be aware of what are the assets that are coming in, because a higher interest rate obviously carries more risk.
I wouldn't say obviously, but
not obviously. Usually, that's the way it's supposed to work.
And what's not calculated in as part of the net interest margin are the losses that the bank is taking on those loans. So the way that you look at say the spread on a credit card issuer, is that you've got this big spread, but then they're going to take higher than average losses. You're going to take more losses on a credit card portfolio than you are on a fixed 30-year, say 50% LTV type of mortgage loan portfolio. So that's why the net interest margin would look a lot higher, but it doesn't necessarily mean that Capital One is that much better than everybody else. And I think also when you start to look at the biggest banks, so then we're talking about JPMorgan and Wells Fargo, Bank of America, they have very large securities portfolios. And particularly right now, what these banks are trying to do is position themselves for the future. And they're all looking at the Fed, trying to figure out what the Fed is going to do, trying to position their securities portfolios that give them some amount of income for today. So they're buying securities that are going to yield something so they can get that money for today. But then B, be prepared for the changes that are going to take place. And what you don't want to necessarily do is lock yourself into 10-year type of maturities, 20-year type of maturities. They'll yield more for today, but those are going to get clobbered if interest rates start to go up like we saw earlier this year.
Right, and you talk about being prepared, and when you say that, you mean that the securities that they hold in their portfolio, so if we think about corporate debt, a Walmart bond, or an agency mortgage-backed security, those are much more liquid than a loan in and of itself to a business. So they're able to, yes, it'll yield a little bit less, but if they need to sell that, there's a much more liquid market for them to do that.
Yeah, the liquidity is a big issue, and then also the duration of them. They could be much shorter duration and give them more flexibility there. So when we look, for example, JPMorgan has a much lower net interest margin than Wells Fargo. But a big part of that is Wells Fargo's security portfolio yields a lot more than JPMorgan's does. So one of the things that I'd be looking for as the interest rate environment changes, how does Wells Fargo's security portfolio fare during that versus JPMorgan's? And what are Wells Fargo's options in terms of redeploying that capital as quickly as JPMorgan's? So it's not just that simple, okay, this net interest margin is bigger than that. You really do have to get down, look at the balance sheet, figure out where all the numbers are coming from, and take a closer look. And I guess one of the other things, in sort of wrapping up here, we didn't talk much about the liability side, but that's important as well. And the funding advantage that one bank can have versus another. The more low cost, even obviously having non-interest deposits helps you a lot.
Right.
But even having a lot of low-cost interest-bearing deposits can help a lot as well. And that is one of the chief advantages to a lot of money center banks, is when they have good core deposits. Even if they're interest-bearing deposits, those can be very low cost. And when I look across, I took a look specifically at 4 banks, JPMorgan, Wells Fargo, US Bancorp, and Bank of America. Wells Fargo, and this isn't a secret to anybody, has a big advantage in terms of its core deposits, not just those non-interest bearing, but the interest bearing. It's got a lot of low-cost interest-bearing deposits. That gives it a big funding advantage, and that'll help even more when interest rates start to go up and they can earn more of a spread on that.
Absolutely.
All right, to the game for today. We're playing a little Would You Rather, and I'm going to start you off with a fun one. This straddles our industry with the technology industry, maybe the pop culture industry. David, would you rather own $1,500 of Apple shares that you could not touch for 5 years, or $1,300 of a basket of 10 bank stocks that you could choose, and you can't touch those for 5 years either?
Well, so you're taking a $200 hit right off the top. So obviously you're gonna have to make that.
If you choose the bank stocks.
If you choose that one. That said, we're biased. We look at banks a lot. I'm going with the 1,300 in 10 bank stocks that I can choose. I think there's a lot of good opportunities out there. Does Apple look cheap? Do I own shares of Apple today? Yeah, I do. Do banks look more attractive in some cases, in my opinion? Yes, I'm going with the 10 baskets.
Do you like asking yourself questions and answering them? Yes, you do.
What about you?
I would probably go with the bank stocks as well. I'm thinking, I'm a shareholder of Apple as well. I think I bought them at a very opportune time. But I think there's more opportunity in the bank stocks right now. Before we move on to the next one, though, the first 3 bank stocks that you put in that group of 10, what would they be?
First 3, put me on the spot.
I am.
Let's go JPMorgan, US Bancorp,
Interesting.
Yes, U.S. Bancorp. And begrudgingly Bank of America. There you go.
Begrudgingly indeed.
All right, next one.
Brian Moynihan is smiling.
Next one that I'll throw over to you. Talking a little dividend stocks here. Would you rather own shares of American Capital Agency or Prospect Capital? And for those who don't know, Prospect Capital is a business development company, so they invest in low, middle market, small companies. They take debt stakes in there, equity stakes there. Both yield double digits. What are you taking?
I'm going with Prospect. Our colleague Jordan Wathen has done a lot of writing on Prospect recently, and I've talked with him a little bit about the company. It seems like they have a very good process figured out, and it seems like they have a strong portfolio, good oversight of that portfolio. It's sort of like investing in a private equity fund, and that's different when we think about private equity. There are a lot of private equity companies on the market today. So if you invest in Blackstone, for instance, that's like investing in the company that runs the private equity portfolio. This is more like investing in the portfolio itself, and I think Prospect has a good portfolio.
I'm going to agree with you. It's an interesting comparison because you look at American Capital Agency, they invest in agency mortgage-backed securities. You don't have to worry about default risk. And you look at Prospect investing in small middle market companies, that's a very big concern is default risk. But like you said, Prospect Capital, they have a very good sourcing model. They source a lot of their deals. They don't rely on other people to do that for them. They have a good track record. So I'm going with Prospect as well.
All right, closing out, as we always do on the Twitter sphere. David, why don't you kick us off with the first tweet?
The first tweet, we're talking about Twitter.
Last tweet.
There we go. From 24/7 Wall Street. Ouch. Twitter chooses to list on NYSE over NASDAQ. Is that a low blow?
I don't think it's
they're a tech company.
I don't think it's a low blow. I think it's kind of understandable. NASDAQ has, and this is the consequence of NASDAQ ending up in the papers kind of over and over again with these tech glitches. And specifically, a big one of those had to do with the Facebook IPO. So we come around to the Twitter IPO, and maybe it's not all that surprising that they want to try something a little
different. Do these exchanges even matter anymore? There's banks on the NASDAQ, there's Twitter on the NYSE. Is it all does it even matter?
Well, the exchanges matter, but the differentiation of NASDAQ as the tech index and NYSE as everything else, I don't think that matters anymore. I think that's equalizing a lot more than it had in the past.
Right.
The next tweet comes from Business Insurance. That's at BUSINS magazine. And it says, Canada, insurers can benefit from catastrophe bonds, says financial regulator. So catastrophe bonds, what these are, it's for viewers that are familiar with mortgage-backed securities, it's kind of similar. It's in a similar vein. Mortgage-backed securities take a whole bunch of mortgages, allow banks to take them off their balance sheet, distribute that risk around. Catastrophe bonds do something similar. They take the potential losses, usually excess of loss risk, of a catastrophe for an insurer, take that off their risk plate, you might say, and package it into bonds that can be sold off to investors. And those investors hold those bonds. Those bonds pay a certain amount, and the bondholders lose if there is a catastrophe that has the loss characteristics that'll cause that.
Insurance for insurance for insurance.
Yeah, basically, and you can even have reinsurers selling catastrophe bonds. So you have an insurer ceding risk to a reinsurer, and then a reinsurer selling off catastrophe bonds. And this could be a good thing for insurers, enabling them to distribute that risk, but it's also a good thing for investment banks. So after Hurricane Sandy, the New York City Metro Transit Authority was looking for a way to help it insure itself, and it issued $200 million of catastrophe bonds, and that offering was managed by Goldman Sachs and a subsidiary of Marsh & McLennan, which is an insurance broker. So it's yet another way for Goldman Sachs and the crew to make money.
Shocker. All right, last tweet of the day. All right, this is an interesting one from Omeed. He says, LOL, Burger King rolling out health-conscious fries. I think they're called Satis fries, by the way. Weeks after rolling out a burger which has fries in it. Matt, are you running out to Burger King right now to get these new Satis fries? Are you trying to remain svelte?
No, I'm not. I've never been it's all about the McDonald's fries. I gotta say, Burger King doesn't make a terrible fry. But if I'm going to have fast food fries, it's got to be McDonald's.
You're picking McDonald's over everything.
I'm picking McDonald's. Yeah.
Best fries you've ever had at McDonald's?
Yeah, I think so.
Wow.
What do you think is better than a McDonald's fry?
Fan of Shake Shack.
What the heck is Shake
You don't know,
Shack?
there's one here in D.C., New York. I'm sure there's one out in L.A. It's an up and coming.
Different than Steak and Shake?
Very different than Steak and Shake.
But
Very,
Steak and
very
Shake is
different.
delicious.
Maybe. Shake Shack's better. Check it out.
So last question. Not only are you getting those fries, but are you eating the burger with the fries on it? And are you demanding Satis fries on your fry burger?
I hope they can do that. Does Burger King take personalized orders? They need to.
Isn't Burger King have it your way, right? That's
Boom.
there
Let's
you go.
Lunchtime.
All right, that's the show for today, folks. We will be back, and when we are, not only will David still be pitching one of his investments later this week, but we'll probably have him on here eating some Satis fries. Until then, though, thanks for watching. We'll see you tomorrow.